Question 1. Regulation of long-term care insurance. Which of the following statements accurately reflects a key aspect of Hawaii's long-term care insurance regulations under the National Association of Insurance Commissioners (NAIC) Model Act? A. Insurers can cancel long-term care insurance policies after 10 years if the insured's health declines significantly. B. Hawaii law requires insurers to provide a minimum inflation protection option with every long-term care insurance policy offered. C. The NAIC Model Act mandates that long-term care insurance policies be guaranteed renewable or non-cancelable. D. Long-term care insurance policies in Hawaii cannot include pre-existing condition exclusions for more than 12 months. Answer. C. Explanation. Under the NAIC Model Act, long-term care insurance policies must be guaranteed renewable or non-cancelable. This means the insurer cannot cancel the policy except for non-payment of premiums. Guaranteed renewability is a core consumer protection provided by Hawaii's adoption of the NAIC Model Act. Option A is incorrect because insurers cannot cancel a policy due to health declines only for non-payment. Option B is incorrect because Hawaii does not mandate a minimum inflation protection option, though such an option must be offered. Option D is incorrect because pre-existing condition exclusions in Hawaii are limited to 6 months, not 12 months. This aligns with consumer protection regulations that ensure fair practices in the underwriting process. Question 2. Scenario-based. Eligibility for benefits. Ms. Garcia, aged 72, has been diagnosed with Alzheimer's disease and has severe cognitive impairment. Her physician certifies that she requires assistance with 2 out of 6 activities of daily living adults. Ms. Garcia's long-term care insurance policy includes benefit triggers related to a DLS and cognitive impairment. What should Ms. Garcia expect regarding her eligibility for long-term care benefits under her policy? A. Ms. Garcia is likely ineligible because she can still perform 4 of the 6 DLS without assistance. B. Ms. Garcia is eligible for benefits as cognitive impairment is a recognized benefit trigger regardless of the number of a DLS she can perform. C. Ms. Garcia will not be eligible unless she also requires assistance with at least 3 adults. D. Ms. Garcia's policy will require a waiting period before she is eligible, and only physical impairments trigger her benefits. Answer. B. Explanation. In most long-term care insurance policies, cognitive impairment alone can be a valid benefit trigger even if the insured can perform some DLS independently. Ms. Garcia's diagnosis of severe cognitive impairment, combined with her need for assistance with 2 adults, satisfies common eligibility criteria for long-term care benefits. Option A is incorrect because a DLS are not the only measure for benefit eligibility. Cognitive impairment is a trigger. Option C is incorrect because most policies only require assistance with 2 adults, not 3. Option D is incorrect because both physical and cognitive impairments can trigger benefits, and policies typically have specified waiting periods, e.g. 90 days before benefits begin, but that is separate from eligibility. Question 3. Premiums and pricing. Which of the following factors does not typically influence the premium for a long-term care insurance policy in Hawaii? A. The applicant's age and health status at the time of application. B. The elimination waiting period chosen by the policyholder. C. The applicant's marital status at the time of application. D. The level of inflation protection included in the policy. Answer. C. Explanation. While age, health status, the elimination period, and inflation protection options all significantly impact the premiums for long-term care insurance, marital status does not directly influence the cost of premiums in Hawaii. Option A is correct because premiums typically increase with age and deteriorating health. Option B is correct because a longer elimination period generally results in lower premiums while a shorter period increases them. Option D is correct because inflation protection, which helps the policy's benefits keep pace with rising costs, will raise the premium. Option C is the correct answer because marital status alone does not influence premium pricing, though some policies may offer spousal or partner discounts, which is a separate consideration from setting base premium rates. Question 4. Policy provisions and features. Which of the following best describes how a waiver of premium or feature works in a long-term care insurance policy? A. Premiums are waived after a policyholder has been receiving benefits for a specified period of time, typically 90 days. B. Premiums are reduced by 50% once a policyholder reaches a certain age, usually 75 or older. C. Premiums are waived once the policyholder's benefits have been exhausted. D. Premiums are waived during the policy's elimination waiting period. Answer A. Explanation. The waiver of premium feature is designed to relieve the policyholder of the burden of paying premiums once they start receiving benefits. Typically, premiums are waived after the policyholder has been receiving benefits for a certain period of time, usually 90 days. Option B is incorrect because waiver of premium is not age-dependent. Option C is incorrect because premiums are waived while receiving benefits, not after benefits are exhausted. Option D is incorrect because the elimination period refers to the time the policyholder must wait before benefits start, and premiums are typically still due during this time. Question 5. Definitions and key concepts. Which of the following is not considered an activity of daily living adult in long-term care insurance policies? A. Bathing. B. Eating. C. Shopping. D. Dressing. Answer C. Explanation. Activities of daily living adults are essential functions that determine eligibility for long-term care benefits. Common ADLS include bathing, eating, dressing, toileting, transferring, and continence. Shopping is not considered an ADL, although it may be part of instrumental activities of daily living adults, which are higher-level tasks not typically used as benefit triggers in long-term care insurance. Option A is incorrect because bathing is an ADL. Option B is incorrect because eating is an ADL. Option D is incorrect because dressing is an ADL. Question 6. Scenario-based. Claims and benefit payments. Mr. Nakamura purchased a long-term care insurance policy with a reimbursement plan. He is now receiving home health care services 3 times a week, which cost $2,000 per month. His policy provides for a daily benefit of $100, and his elimination period has already passed. What can Mr. Nakamura expect in terms of benefit payments? A. Mr. Nakamura will receive $100 per day, regardless of the actual cost of his care. B. Mr. Nakamura will receive $3,000 per month since that is the maximum monthly benefit. C. Mr. Nakamura will be reimbursed for the actual cost of his care up to the daily benefit of $100, which totals $2,000 per month. D. Mr. Nakamura will not receive any payments because home health care is not covered by his policy. Answer C. Explanation. With a reimbursement plan, the insurance company reimburses the policyholder for the actual cost of long-term care services up to the daily benefit amount specified in the policy. Since Mr. Nakamura's home health care costs $2,000 per month and his policy provides a daily benefit of $100, his monthly reimbursement will be capped at $2,000. Option A is incorrect because reimbursement policies only cover actual costs up to the daily benefit. Option B is incorrect because $3,000 exceeds the cost of care, and reimbursement policies do not pay more than the actual costs. Option D is incorrect because home health care is generally covered under most long-term care insurance policies. Question 7. Premiums and pricing. Which factor is least likely to affect the premiums for a long-term care insurance policy in Hawaii? A. The policyholder's age at the time of application. B. The presence of a guaranteed renewability clause in the policy. C. The elimination period chosen by the policyholder. D. The inclusion of inflation protection in the policy. Answer B. Explanation. Guaranteed renewability is a standard feature required by the NAIC Model Act and does not directly impact premiums. It ensures the policyholder can renew the policy as long as premiums are paid, but it does not make the policy more expensive. Option A is incorrect because age significantly affects premiums. Older applicants typically face higher premiums. Option C is incorrect because the elimination period, how long the policyholder waits before benefits begin, affects premiums, with longer waiting periods reducing premiums. Option D is incorrect because inflation protection raises premiums as it ensures benefits keep up with rising care costs. Question 8. Eligibility for benefits. What is the primary benefit trigger for receiving long-term care insurance benefits in Hawaii? A. A physician certifies that the insured needs assistance with one or more activities of daily living adults. B. The insured's policy has been in force for at least 10 years. C. The insured has been unable to perform at least 2 ADLS or has significant cognitive impairment. D. The insured's medical expenses exceed a specified threshold set by the state. Answer C. Explanation. The most common benefit trigger in long-term care insurance policies is the inability to perform at least 2 of the 6 ADLS or the presence of a significant cognitive impairment. such as Alzheimer's disease, is standard as consistent across most policies and states, including Hawaii. Option A is incorrect because benefit triggers generally require difficulty with two or more adults, not just one. Option B is incorrect because the length of time the policy has been enforced does not directly trigger benefits. Option D is incorrect because long-term care benefits are not based on the insured's total medical expenses but on the insured's functional or cognitive status. Question 9. Long-term care insurance partnership program. Which of the following is a key advantage of purchasing a long-term care insurance policy through Hawaii's Long-Term Care Partnership Program? A. The policyholder is eligible for Medicare to cover long-term care costs after the policy is exhausted. B. The policyholder qualifies for a federal tax credit for each year of coverage. C. The policyholder's assets are protected from Medicaid spend-down requirements up to the amount of benefits paid by the policy. D. The policyholder receives a 25% reduction in premiums after holding the policy for 5 years. Answer C. Explanation. Hawaii's Long-Term Care Partnership Program provides asset protection to policyholders when the policyholder applies for Medicaid. The amount of benefits received from the partnership policy is disregarded from Medicaid asset tests, allowing the policyholder to protect that portion of their assets. Option A is incorrect because Medicare does not cover long-term care beyond short-term services like skilled nursing care. Option B is incorrect because federal tax credits are not tied directly to partnership policies. Option D is incorrect because the program does not provide premium reductions based on the length of policy ownership. Question 10. Tax implications. Which of the following is true regarding tax-qualified long-term care insurance policies in Hawaii? A. The premiums for tax-qualified policies are always fully deductible for individuals, regardless of income. B. Benefits paid from tax-qualified policies are taxable as income to the policyholder. C. Premiums for tax-qualified policies may be deductible as a medical expense subject to certain limitations based on age and income. D. Hawaii does not recognize the tax-qualified status of long-term care insurance policies. Answer C. Explanation. Premiums paid for tax-qualified long-term care insurance policies may be deductible as a medical expense, but this deduction is subject to limitations based on the taxpayer's age and adjusted gross income. OGI. Benefits from tax-qualified policies are generally not taxable as income. Option A is incorrect because premium deductions are not guaranteed and depend on the policyholder's age and income. Option B is incorrect because benefits from tax-qualified policies are typically not taxable. Option D is incorrect because Hawaii does recognize tax-qualified long-term care insurance policies. Question 11. Long-term care insurance riders. Which of the following riders in a long-term care insurance policy allows a policyholder to increase their daily benefit to keep up with inflation without proving insurability? A. Return of premium rider. B. Non-forfeiture benefit rider. C. Guaranteed purchase option GPO rider. D. Inflation protection rider. Answer D. Explanation. An inflation protection rider allows the policyholder's daily benefit to increase over time to keep pace with inflation, ensuring that benefits do not lose value. It is a common feature in long-term care policies and can be critical as care costs rise. Option A is incorrect because a return of premium rider returns premiums to beneficiaries if the policyholder passes away without using the benefits. Option B is incorrect because a non-forfeiture benefit rider allows the policyholder to retain some coverage if they stop paying premiums. Option C is incorrect because the guaranteed purchase option GPO rider allows for future benefit increases but typically requires the policyholder to pay additional premiums at the time of each increase. Question 12. Tax qualified versus non-tax qualified policies. What is the main distinction between a tax qualified and a non-tax qualified long-term care insurance policy? A. Tax qualified policies are only available to individuals over 65, while non-tax qualified policies are available to all ages. B. Benefits from a tax qualified policy are usually tax-free, while benefits from a non-tax qualified policy may be taxable. C. Premiums for non-tax qualified policies are fully tax deductible, while tax qualified policy premiums are not. D. Tax qualified policies require a medical exam for eligibility, whereas non-tax qualified policies do not. Answer B. Explanation. The primary difference is that benefits from tax-qualified long-term care insurance policies are generally not taxable, while benefits from non-tax qualified policies may be subject to taxes. Premiums for tax-qualified policies may also be deductible as medical expenses under certain circumstances. Option A is incorrect because tax-qualified policies are available to individuals of all ages. Option C is incorrect because premiums for tax-qualified policies may be tax-deductible, not those for non-tax-qualified policies. Option D is incorrect because eligibility criteria, including medical exams, are not determined by the tax-qualified status of the policy. Question 13. Partnership Program. In Hawaii, what happens to an individual's assets if they exhaust their benefits from a partnership long-term care insurance policy and then apply for Medicaid? A. The individual's entire estate is subject to Medicaid spend-down rules. B. The individual's assets up to the amount paid by the insurance policy are protected from Medicaid's asset spend-down requirements. C. The individual's home is automatically transferred to Medicaid in exchange for benefits. D. The individual must requalify for Medicaid after benefits are exhausted, with no special asset protection. Answer B. Explanation. The Hawaii Long-Term Care Partnership Program allows individuals to protect assets equal to the benefits paid by their partnership policy from Medicaid's spend-down requirements. This allows policyholders to qualify for Medicaid without losing all their assets. Option A is incorrect because the program protects assets. Option C is incorrect because the home is not automatically transferred to Medicaid. Option D is incorrect because asset protection is a key feature of the program. Question 14. Elimination period. The elimination period in a long-term care insurance policy refers to A. The time period before the policyholder can purchase additional coverage. B. The number of days the policyholder must wait after becoming eligible for benefits before benefits are paid. C. The period during which the insurance company can deny a claim based on pre-existing conditions. D. The duration of coverage provided by the policy. Answer B. Explanation. The elimination period is the waiting period after a qualifying event during which the policyholder must cover their own care expenses before the insurance benefits begin. Common elimination periods range from 30 to 180 days. Option A is incorrect because the elimination period does not pertain to purchasing additional coverage. Option C is incorrect because pre-existing conditions are handled differently by policies, not through the elimination period. Option D is incorrect because the elimination period refers to the waiting time, not the length of coverage. Question 15. Benefit types. Which of the following types of long-term care policies offers flexibility in where care can be received, including home care, adult daycare, and nursing home care? A. Facility-only policies. B. Comprehensive policies. C. Group policies. D. Limited benefit policies. Answer B. Explanation. Comprehensive long-term care insurance policies provide coverage for care in a variety of settings, including home care, adult daycare, assisted living, and nursing homes, offering flexibility to meet the policyholder's needs. Option A is incorrect because facility-only policies cover care provided only in certain types of facilities, such as nursing homes. Option C is incorrect because group policies are typically offered by employers and may have limited coverage options. Option D is incorrect because limited benefit policies provide coverage for only specific types of care. Question 16. Scenario-based. Coverage limits. Ms. Lee purchased a long-term care insurance policy with a benefit limit of $150,000 and a daily benefit of $200. She needs nursing home care, which costs $180 per day. How long will her policy last if she receives care every day at this rate? A. 750 days. B. 833 days. C. 1,000 days. D. 1,250 days. Answer B. Explanation. Ms. Lee's policy provides a daily benefit of $200, but her care costs $180 per day. The total benefit limit of $150,000 will last for $150,000, $180 equals 833 days. Option A is incorrect because it does not account for the lower daily care cost. Option C is incorrect because it assumes a daily cost of $150, not $180. Option D is incorrect because it exceeds the maximum benefit. Question 17. Spousal discounts. Many long-term care insurance companies offer spousal discounts when A. Both spouses purchase policies from the same insurer. B. The couple agrees to a shared benefit plan. C. One spouse purchases a policy and the other is automatically covered. D. Both spouses agree to an extended elimination period. Answer A. Explanation. Insurers often provide spousal discounts when both spouses purchase long-term care insurance policies from the same company, typically offering 1030% off premiums for each policyholder. Option B is incorrect because a shared benefit plan is a separate feature. Option C is incorrect because each spouse typically needs their own policy. Option D is incorrect because elimination periods do not directly affect spousal discounts. Question 18. Return of premium feature. Which of the following best describes a return of premium feature in a long-term care insurance policy? A. The insurance company refunds all premiums if no benefits are ever paid out. B. Premiums are returned if the policyholder is unsatisfied within the first 30 days of purchasing the policy. C. Premiums are returned if the policyholder's death occurs before any benefits are used minus any claims paid. D. The insurance company pays back premiums during periods when the policyholder does not require care. Answer C. Explanation. A return of premium feature typically returns the paid premiums to the policyholder's beneficiaries upon the policyholder's death, minus any claims paid out by the policy. This feature can provide value to policyholders who do not end up using their long-term care benefits. Option A is incorrect because premiums are not refunded automatically unless specified. Option B is incorrect because a 30-day return option is standard but is not considered a return of premium feature. Option D is incorrect because premiums are not typically refunded during periods of non-use. Question 19. Shared benefit plans. A shared benefit plan in long-term care insurance allows two individuals to share a policy and divide the total benefit amount between them. B. A policyholder to transfer unused benefits to their spouse if they die. C. A single policyholder to use benefits for multiple types of care, such as home care and nursing home care. D. A policyholder to share their premium costs with their employer. Answer A. Explanation. A shared benefit plan allows two policyholders, often spouses, to pool their total long-term care benefits. If one spouse uses up all of their individual benefits, they can tap into the other spouse's benefit pool if necessary. Option B is incorrect because benefits are shared while both spouses are living. Option C is incorrect because this refers to comprehensive coverage, not shared benefit plans. Option D is incorrect because shared benefit plans pertain to benefits, not premium payments. Question 20. Policy exclusions. Which of the following is typically excluded from long-term care insurance coverage? A. Nursing home care. B. Care required due to self-inflicted injury. C. Hospice care. D. Adult day care services. Answer B. Explanation. Long-term care insurance policies typically exclude coverage for care required due to self-inflicted injuries or attempted suicide. Such exclusions help insurers manage risk and ensure that coverage is used for legitimate medical needs, not for situations resulting from intentional harm. Option A is incorrect because nursing home care is a standard component of long-term care coverage. Option C is incorrect because hospice care is often covered as it focuses on end-of-life support, although policies may vary. Option D is incorrect because adult day care services are commonly covered by long-term care policies. Question 21. Care coordination benefits. What is the purpose of care coordination benefits in a long-term care insurance policy? A. To allow policyholders to receive care from a relative at no cost. B. To provide a nurse or social worker to help plan and manage the policyholder's care. C. To reimburse the policyholder for caregiving expenses. D. To cover all out-of-pocket costs related to long-term care. Answer B. Explanation. Care coordination benefits provide the policyholder with access to a professional such as a nurse or social worker who helps plan, manage, and coordinate long-term care services. This ensures that the policyholder receives appropriate and efficient care based on their needs. Option A is incorrect because care coordination does not involve free care from relatives. Option C is incorrect because care coordination focuses on planning care, not reimbursing expenses directly. Option D is incorrect because out-of-pocket costs are not fully covered by this feature alone. Question 22. Respite care. In the context of long-term care insurance, what is respite care? A. Temporary care provided to give a primary caregiver a break from caregiving duties. B. Full-time care in a nursing home facility. C. Hospice care for terminally ill individuals. D. Emergency care required during an acute health crisis. Answer A. Explanation. Respite care refers to temporary care provided to relieve a primary caregiver for a short period, allowing them to rest or attend to personal matters. Long-term care insurance policies often include this feature to support family caregivers. Option B is incorrect because full-time care in a nursing home is not considered respite care. Option C is incorrect because hospice care is end-of-life care, not respite care. Option D is incorrect because respite care is not intended for emergencies. Question 23. Premium waiver provision. Which of the following best describes the premium waiver provision in a long-term care insurance policy? A. Premiums are waived if the policyholder becomes unemployed. B. Premiums are waived while the policyholder is receiving long-term care benefits. C. Premiums are waived after the policyholder reaches a certain age. D. Premiums are waived if the policyholder does not use their benefits for a specified period. Answer B. Explanation. The premium waiver provision in long-term care insurance typically means that once the policyholder starts receiving benefits, they no longer have to pay premiums. This prevents the policyholder from facing financial strain while already utilizing the policy's benefits. Option A is incorrect because the premium waiver provision is unrelated to unemployment. Option C is incorrect because premium waivers are generally tied to receiving care, not reaching a certain age. Option D is incorrect because waivers do not apply due to non-use. Question 24. Non-forfeiture benefits. The non-forfeiture benefit in a long-term care insurance policy ensures that A. The policyholder receives a full refund if they cancel the policy. B. The policyholder retains some benefits if they stop paying premiums after a certain period. C. The insurance company cannot cancel the policy for any reason. D. The policyholder can transfer the policy to a family member. Answer B. Explanation. A non-forfeiture benefit ensures that if the policyholder stops paying premiums after a certain period, they will still retain reduced coverage rather than losing the policy entirely. This provision protects the policyholder from losing all benefits after years of premium payments. Option A is incorrect because a full refund is not typically offered. Option C is incorrect because policies can be cancelled under specific conditions, such as fraud. Option D is incorrect because policies are not transferable to family members. Question 25. Benefit triggers. Which of the following is a common benefit trigger for long-term care insurance? A. A medical condition requiring surgery. B. The inability to perform two or more activities of daily living adults. C. Retirement from full-time employment. D. The diagnosis of a terminal illness. Answer B. Explanation. Long-term care insurance benefits are typically triggered when the policyholder is unable to perform two or more activities of daily living adults, such as bathing, dressing, or eating. This standard measure indicates that the individual requires assistance with basic self-care. Option A is incorrect because surgery does not generally trigger long-term care benefits. Option C is incorrect because retirement is not a benefit trigger. Option D is incorrect because terminal illness may qualify for other types of insurance but is not a primary trigger for long-term care benefits. Question 26. Guaranteed renewable policies. What does it mean for a long-term care insurance policy to be guaranteed renewable? A. The policyholder can renew the policy at a low premium rate. B. The insurer cannot cancel the policy as long as the policyholder continues to pay premiums. C. The policyholder can choose to increase their benefits without a medical exam. D. The policyholder can transfer the policy to a family member if they no longer need it. Answer B. Explanation. A guaranteed renewable policy means that the insurer cannot cancel the policy as long as the policyholder continues to pay the required premiums. This provides security for the policyholder, knowing that coverage will remain in effect. Option A is incorrect because premiums may increase, but the policy cannot be cancelled. Option C is incorrect because increasing benefits typically requires additional underwriting. Option D is incorrect because policies are not transferable. Question 27. Cognitive impairment coverage. Which of the following conditions would typically trigger benefits from a long-term care insurance policy's cognitive impairment provision? A. Alzheimer's disease. B. Diabetes. C. Arthritis. D. Heart disease. Answer A. Explanation. Cognitive impairment provisions in long-term care insurance policies are designed to provide benefits for individuals suffering from conditions such as Alzheimer's disease or other forms of dementia that impair mental functioning and memory. Option B is incorrect because diabetes does not generally involve cognitive impairment. Option C is incorrect because arthritis affects physical mobility, not cognitive function. Option D is incorrect because heart disease is not related to cognitive function. Question 28. Partnership policies and Medicaid in Hawaii. What is the main benefit of purchasing a partnership long-term care insurance policy in relation to Medicaid? A. It guarantees lifetime care without limits. B. It protects assets from Medicaid spend-down requirements equal to the benefits paid by the policy. C. It provides double the benefit amount under state law. D. It ensures that Medicaid will cover all remaining care costs. Answer B. Explanation. Hawaii's partnership long-term care insurance policies allow policyholders to protect assets equal to the amount paid out by the policy from Medicaid spend-down requirements. This allows them to qualify for Medicaid without losing all their assets. Option A is incorrect because it does not guarantee lifetime care. Option C is incorrect because benefits are not doubled under state law. Option D is incorrect because Medicaid will not necessarily cover all remaining costs. Question 29. Inflation protection in long-term care insurance. Why is inflation protection an important feature in long-term care insurance policies? A. It guarantees that premiums will never increase. B. It allows the policyholder to receive care in any state. C. It adjusts the policy's benefit amounts to keep pace with rising healthcare costs over time. D. It covers all out-of-pocket costs during long-term care. Answer C. Explanation. Inflation protection is an important feature in long-term care insurance because it adjusts the policy's benefit amounts to account for the rising costs of healthcare and long-term care over time. Without inflation protection, the benefits may become insufficient to cover the actual costs when care is needed. Option A is incorrect because inflation protection does not guarantee stable premiums. Option B is incorrect because it does not affect where care can be received. Option D is incorrect because inflation protection relates to increasing benefits, not covering all costs. Question 30. Elimination period in long-term care insurance. What is the elimination period in a long-term care insurance policy? A. The period during which the policyholder can cancel the policy for a full refund. B. The amount of time a policyholder must wait before benefits are paid after qualifying for care. C. The time during which premiums are waived after the policyholder begins receiving benefits. D. The time when the policy is void if no claims are made. Answer B. Explanation. The elimination period is a waiting period in a long-term care insurance policy during which the policyholder must wait after qualifying for care before benefits start to be paid. This is often compared to a deductible in health insurance as the policyholder bears the cost of care during this period. Option A is incorrect because the elimination period does not refer to policy cancellation. Option C is incorrect because the elimination period is not related to the waiver of premiums. Option D is incorrect because the elimination period has no bearing on voiding the policy.